Palo Alto Networks will report their quarterly earnings a week from today. So let's have a quick recap of what has happened with the company and especially with the stock right now. What are the expectations? And let's see whether or not it makes sense to buy that stock before the earnings report. Currently, these are the expectations for the quarter. So EPS normalized estimates $1.25, EPS on a GAAP estimate 41 cents, revenue estimate $1.97 billion. In the last 90 days, we've had 5 EPS revisions on the upside and 30 on the downside. With regards to valuation metrics, a couple of here, we're going to go and look at some others in just a second. Forward PE 53.4 times, EV to sales 11.2 times, and EV to EBITDA 36.1 times, so definitely not on the cheapest front. With regards to the price target, the average analyst price target for the next 12 months sits at $335.9, representing around 13% upside from the price we're at today. The stock is flat-ish year to date, and it's down around 21% since the last earnings report. If we currently look at some other metrics, by the way, it has a market cap of around $96 billion. As we've seen, forward PE, EV to EBITDA, price to sales 11.3 times, price to free cash flow, that's in the last 12 months, that sits at 32.9 times. Again, not on the cheapest front, but there is some explanations with regards to that. Price earnings to growth, 2.15. Then with regards to shares outstanding and free cash flow per share, so shares outstanding have gone up quite a lot in the last 10 years, and free cash flow per share has also increased quite a lot in the last 10 years, which probably means that in the future the company will be able to buy back quite a lot of shares, because as we can see here in the last 10 years, shares outstanding have risen by around 42%. So that's basically the current state of the stock. Now let's have a look at what has happened with regards to the company. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, would really appreciate that. Want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. And of course, let me know which cybersecurity company, which cybersecurity stock you have in your portfolio. So let's go back to a couple of comments that were mentioned in the last earnings call. So with regards to guidance, because guidance was the issue, the quarter was a strong one, guidance was a bit weaker than expected. There is a reason for that. So our guidance is a consequence of us driving a shift in our strategy in wanting to accelerate both our platformatization and consolidation and activating our AI leadership. We believe this is the time for us to invest, given our leadership position in the market and our leadership position across platformatization and consolidation. But before I talk about that more as to how we intend to accelerate our growth prospects in the future and drive towards a much higher aspiration of $15 billion in ARR by 2030, I want to give you a candid view of where we see the cybersecurity market and the demand function out there. The demand story is no different from prior quarters, and on the margin continues to get stronger. There are multiple drivers fueling this. The threat landscape continues to challenge our customers with increasing scale and sophistication attacks. Now, with regards to the acceleration of both platformatization and consolidation, of course, that's why in the short term, they do take a little hit, as they provided here some more information in their own slides. So short-term impact will drive superior long-term financial outcomes. As you can see here, billings growth and revenue growth in the short term will get impacted, but over the long run, it is supposed to pay, and quite handsomely. So superior long-term financial outcomes, we've just read about the $15 billion opportunity, but here recurring revenue in 2030, over 90%. Recurring revenue represents total revenue less hardware and professional services revenue. And of course, further upside potential from AI. Now, what is this platformatization consolidation? Well, it's basically this. They now have here 3 segments: network security, cloud security, and security operations, under which they have various offerings, which of course, if we go back to the words platformatization and consolidation, basically offering a full platform with all the solutions that you need. You consolidate, well, you have to consolidate all the product offering, but you're also going to consolidate the other players in that industry. Right now, one company goes to multiple companies because each and every company has something else to offer. There's going to be some huge consolidation in that industry. One of the big winners, in my opinion, will be Palo Alto. Of course, you have guys like CrowdStrike, SentinelOne that are doing quite well. And so if we look at some of the numbers from last quarter, so it was the 8th consecutive quarter of operating margin expansion. Total revenue came in at $1.98 billion, that's up 19% year over year. Remaining performance obligation, $10.8 billion, up 22% year over year, so growing faster than revenue. NGS ARR, $3.49 billion, up 50% year over year. Total billings was up 16% year over year to $2.35 billion. Then with regards to the operating leverage, so operating income non-GAAP up 50% year over year, operating margin up 580 basis points year over year, adjusted free cash flow up $215 million on a trailing 12 months basis, and EPS non-GAAP as well is up 39% year over year. So we can clearly see that profitability side of the business is becoming better and better. And so again, you might say, okay, this doesn't make sense. Why did this company take such a big hit? Well, first of all, also, it was trading at quite a high premium. And then when the market saw this, basically Q3 guidance, total revenue only coming between 13 to 15% growth year over year, total billings only between 2 to 4% growth year over year, EPS same as revenue, 14% year over year growth. At the midpoint, the market was unimpressed. When you look at fiscal year 2024, total billings will grow around 10 to 11% year over year. Next gen security ARR, 34 to 35% year over year. Total revenue, 15.5% year over year at the midpoint. With regards to operating margin on a non-GAAP, an increase of around 240 to 290 basis points year over year. And EPS growing at around 24% year over year at the midpoint. The problem, again, as we've seen with plenty of other good earnings reports, is that when you are trading at a high premium going into the earnings season, you're basically priced to perfection. And so if the market sees some weakness, even though it makes sense for the long run, if it sees some weakness in the short term, your stock is going to get punished. We've seen that with, for example, Adyen, I know, a company in a whole other industry. But the same thing happened there. Last August, stock crashed around 55% or so because they did say that in the short term, they're going to take a hit with regards to margins. The market didn't like that because, again, this was a great company, but trading at a high premium. And if in the short term, you're going to show the market a little bit of weakness, even though it makes sense, you're investing for your long-term success, then you're going to get penalized. But as we've seen with Adyen and other companies as well, it's a short-term hit. And then the market does realize, look, okay, it makes sense. So, okay, buy the dip opportunity type of thing. So in my opinion, I think the market will see the same thing here with Palo Alto. And if you look at the stock, since we went under the 200-day moving average after they reported their February earnings, the stock did rebound and we did stay above the 200-day moving average for most of the time. We did have a dip once or twice here, but a quick recovery, and now we're over the 20, the 50, and the 200-day moving average. RSI is neutral, but has some positive momentum there, even though in the last 3 weeks we have 3 red candles, but not much has happened. We did go a little bit higher, so we're getting a bit more support right now on a technical aspect. But of course, as we know, in earnings season, doesn't really matter what the charts tell us, because if the numbers are great, you're going to get rewarded. If the numbers are okay, meeting expectations, but there was a lot of anticipation, you're going to get punished. And the same with, of course, a miss. Of course, guidance is going to be of extreme importance. Since they did make that switch last quarter, the market, some analysts would like to hear a bit more about the company's, let's say, roadmap in the next coming quarters. So overall, in my opinion, taking a bet before the earnings report is a risky thing. If you already hold shares of Palo Alto right now, my opinion as well is the same thing. Wait a little bit, because let's say great report, stock goes up. You might say, oh, I missed a chance. No, but you already have some shares. So you don't miss a chance. You get more information and then you can act accordingly. If you did not have shares right now, then I would say again, wait. Or if you want to take the risk because you don't want to buy 10% higher afterwards, open a tiny position and then allocate accordingly, because the stock can go up but can go down quite fast as well. So those are the scenarios. Those are just my thoughts right now with regards to Palo Alto. I like the company. It's still not in my portfolio anymore. I did buy the dip, but then traded it. So that's about that. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.